Welcome back. On the show right now, we're going to be talking to Malte Kaub from Traders Leadership Council. Welcome to the show.
Thanks for having me back.
So today we're going to talk about, kind of the usual thing of what it takes to take, somebody who's kind of making mistakes and turn them into a profitable trader. So, what's the process that you go through?
Yeah, absolutely. So I'm working with a lot of traders who try to make that journey to become a consistently profitable trader. And what we see a lot with traders, and it's probably good to have a look also at that next slide, is that after people open a trading account, what we often see is they open small positions and they turn out to be profitable trades and think, oh, well, this is the easiest thing ever. And what really changes when the trading is increasing the position size. So I've seen that time after time, once they increase the position size from, let's say, a micro lot to a mini lot to a real lot, 2.5 lots and so forth, suddenly the losing trades come in, and they crush 70% of the trading capital. And most traders really don't survive that learning curve and become consistently profitable traders.
So you take somebody, you push them back into taking their small sizes?
Yeah, exactly. So there's a couple of ways of dealing with that. One is you reward yourself for good trading with increasing your position size gradually. You don't just increase your position size by the factor 10 immediately. Otherwise, exactly this will happen. You will probably lose your trading account in the first 3 to 6 months, and you will probably never come back to trading.
Yeah. So you kind of got this process that you look at. You kind of looking at what kind of trader you are, and how does that help?
Exactly. So I use a 2x2 matrix. The next slide lays that out. So I asked hundreds and hundreds of traders 2 questions. Do you have a strategy or don't you have a strategy? And the second question then is, do you think you are a disciplined trader? Are you good at executing your strategy, or you're not a disciplined trader? And it's interesting to get the feedback from the traders. Again, I've done that probably with plus 1,000 traders so far, and most would put themselves in category number 2, where they say, well, I kind of have a strategy, but I'm not really the most disciplined trader. Yeah. If you put some pressure on what kind of strategy do you have, can you articulate your strategy? Well, I think a lot of traders then agree that they should probably move down to category number 4.
Lots of people who say they do have good discipline, then you see what they do and you realize that they're definitely in category 2 rather than 1.
Exactly. And I even come across a bunch of traders who'd say, like, they're very disciplined, but they have no strategy. So what does that tell us?
Yeah.
So everybody tries to move or migrate to box number 1, right? I'm a good, disciplined, I execute my strategy, I only trade when I'm fit and all that. I respect my money management and risk management, and I do have a strategy that clearly defines when do I get into the market and where do I leave the market again.
Yeah. You kind of look to within that kind of how you approach your trading, you've got these key elements that you look at, and I suppose there's lots of people who tend to focus on just one aspect of those things. They look at risk management, they look at money management, they look at that, and they look at psychology. But you're saying you should look at the whole kind of elements of it.
Yeah, absolutely. I suppose there's always a big debate. Is one of the aspects more important than the others? But the next slide lays out the 3 elements that I've identified, again, talking to hundreds and hundreds of traders, and also based on my own experience. And the 3 aspects being, 1, risk management, the second one, money management, and the third one being psychology. I'd be happy to kind of quickly comment on kind of the main themes everybody should know, covering these 3 areas. So number 1, and it would be also interesting obviously to get your perspective, risk management. I think the major challenge that many traders experience is that they look at a single trade, and they say, oh, that was a successful trade, hence I'm a fantastic trader. And then the next trade goes wrong, and they are really frustrated. A successful trader looks at 10, 50, 100 trades, does the analysis, and then we'll have a look at the strategy, refine maybe the risk management in the strategy to get to a different win-loss ratio, but really looking at larger batches of trades and not singular trades. That's the key differentiator.
Yeah, I think there's a big risk that when people are looking at their strategies, there's this failure of empiricism. People look at a very small data set. Even if you're looking at over 5 years or 10 years, that's still a very small amount of time. If you're looking at macro pictures, if you're looking at what will happen to euro dollar if the Fed hikes rates, well, how many times have the Fed hiked rates in the last 10 years? How many times have the Fed hiked rates in the last 50 years? Even that is not that many times.
Right.
And so I think there's this risk that when you're looking at your risk management, you're looking at your strategies, you kind of consider how often these events have happened, and that you can't look at past performance to judge future performance as well is a big issue there. I mean, that disclaimer that any financial product you ever buy tells you this, but people forget that.
Yeah, exactly. So really making that switch is a really good starting point, and not getting frustrated when you have one or two losing trades. But look at your risk management, look at your win rates over a larger number of trades. That will give you an indication of how your strategy is performing. The second one would be money management, obviously quite linked to it, but separate. And what I try to highlight on the slide, so don't get confused by all the graphics, really the theme here is if you put too much risk in a given trade, if you double down your risk, if you follow a martingale strategy, the probability just exponentially increases that you blow your account very quickly, right? So martingale strategy, you only need, regardless of the size of account, you need 6-7 trades and your account is gone. A 1 million account is gone if you just double your risk all the time. But if you stay on a 1% or 2% risk of your equity per trade, your trading strategy can, for 2%, for example, it can sustain a series of 10, 15, 20 losers in a row, which will happen to a strategy, and can still then kind of have enough room to show its power and survive these kind of really difficult periods.
Yeah, I suppose the moral here is that you want to live to trade another day, don't you? And
and I think that's also a bit of a sobering fact in there. So trading is not a get-rich-quick scheme. So if you have a very small account and you follow a very prudent money management strategy, that also means that you don't have 300% upside every month. But you also don't have the downside. And many traders underestimate that.
And kind of looking at the next slide along, looking at the kind of psychology of traders, and it's all part of that. You know, when you get into this losing streak or you get into a winning streak, and they're both equally as dangerous in terms of how you approach your trading. And
exactly. So we see both. So we see one is performance anxiety. So people have a number of unsuccessful trades, and when they're really hesitant to pull the trigger for the next trade. And if you have a trend following strategy, maybe that is that one trade out of 10 that you really need to be successful. And when you're on the other side, we've seen something that's being called the God complex. You have a couple of really good trades, you increase your position size, things go your way, and you think you can't fail. And what typically happens is that at some point fear kicks in, and it will change your behavior. So you can have the best risk management and the best money management and the best strategy, but if you're not able to execute the strategy in a flawless way, the strategy is almost worthless, because you can't really unfold its true power. So one suggestion I often give traders is maybe for the next 50 trades, you take very small position sizes, and the only thing you really look at is, have I executed the trades in line with my strategy? And not look at wins or loss, just look at execution to really hone in that skill to improve execution of your strategy.
I mean, should traders always trade live, or should they trade on kind of demo to practice stuff?
That's a very good point. So I have a very clear view on that. They should, in my view, they should have a little bit of skin in the game, even if it's just a micro lot, even if you just have a couple of pence in every trade, that will change your perception of the trade and your behavior, and really have an impact on your psychology.
Because the things that you learn from the psychology point of view, if you're just trading with fake money, that's not real that's not real kind of teaching us about psychology. And well, thank you very much. That was a great kind of run through about those kind of common mistakes that you make when you're trading, and that you kind of see it again and again. Thank you much to Malte Kaub from the Traders Leadership Council.
Thank you very much.
Thank you. And we'll see you straight after the break. Thank you.